Hey everyone, Jason Engelman here, CEO of Freaky Fast Home Buyers and Freaky Fast Capital Group. Thank you so much for tuning in to our podcast, Building Generational Wealth Brick by Brick, doing single family homes. And we got Collin. What's your last name? Teasing. Collin Campbell here.
Wow, I already forgot.
Yeah, right.
Man.
With us, one of our newest team members, obviously working with investor relations. And so we've got a great topic today that you came up with.
Yeah, this was my idea. So, coming into the single family space, right, I always had this very deep interest. Like, as soon as I learned our investment thesis that we have here at Freaky Fast, okay, we're purchasing these homes, sometimes less than $100K. Most people looking at homes today are not looking at that type of price point for a home. And I'm like, how does this even make sense? How are we getting homes for less than $100K? How are we then turning those homes, making a good profit on them? And I learned that the secret sauce, so to speak, to the asset class that we're purchasing in is key to what we're doing here at Freaky Fast, right? And so what we're talking about today is why asset class matters in single-family home investing. You could say that for any type of real estate investing, sure. But we're talking about specifically single-family homes. Why does asset class matter, and why specifically do we invest in C-class, what we would call kind of C-class single-family homes?
Yep.
Right. And so, maybe for our listeners out there who are just getting started with real estate investing, they're like, okay, classes. The only classes I know about are my 8th grade class. Can you give us just maybe a quick rundown of the different type of classes and that sort of thing in real estate?
Sure. So what's interesting to me is how there's different definitions by that person that's trying to describe what the different class is.
Yeah. Sure.
I've talked to multiple investors and they're like, well, I consider that house a C class. And you talk to another person and they're like, well, I consider that a B class. So some of it is somewhat preference.
Yeah,
it's
a little bit of an ambiguous kind of thing to talk about.
And that was probably one of the toughest things that I had to learn, I guess, when I first got into real estate investing. Because someone asked me what class, and it's like, well, I don't know. What do you consider a B or C class?
Right. Yeah.
I remember one of my friends who was an investor had been doing this in his, for I think over 20 years. He came and visited us in Columbus, Georgia. We were still only really buying in Columbus at the time. And, I told him, I was like, yeah, we have C-class properties. And he came and he looked at them. He's like, well, I would consider these B-class. And he was coming from Gary, Indiana, where, at that time was really, really rough. And it still is in some areas. And we now invest in Gary.
Yeah.
And but I could see where he was kind of coming from compared to some of the neighborhoods that he was in. His were more C-class, and maybe these were B for any particular reason.
Yeah.
A lot of times I think people use school districts as a reference point. Some people use, is it in a high traffic area, a lot of businesses, that sort of thing. Is it in an older neighborhood, houses are older, or is it what's the crime in that neighborhood and the different levels? So for me, it really comes down to a few things. You have your A class, which is newer builds or kind of more on the higher end of value.
Yeah, so pricing is probably one kind of metric we would use there. That makes sense.
Yep. And then obviously if it's in a more middle-class suburb, and you got better school districts, that adds to the support of it being an A-class neighborhood.
Yeah, makes sense.
But, being a C-class, maybe a B-class is they're older homes, but still nicer. They're more on the higher end in the sense of middle-class families live there.
Yeah.
C-class, you're looking at, still nicer places to live, but homes need to be upgraded. Yeah. Homes need to be updated. They're older, very much blue-collar type neighborhoods and people living there. Not that that's a bad thing, but that's what they kind of afford, the price. So for me, really, it comes down to price and the quality of home more than it does school districts and crime. Now, because you'll see some crime kind of shift into maybe like a C-class neighborhood, but as those houses are updating and turn into nicer quality homes,
Yeah.
you see better quality families moving in there. If versus crime and things like that. So you'll see that kind of go down and that regentrification taking place in those neighborhoods.
Sure, makes a lot of sense.
D class is when there's crack houses across the street and there's a lot of traffic going in. Those are the neighborhoods you want to stay out of.
Yeah.
But so that's kind of how I classify. And again, 10 different investors will give you 10 different answers.
Yeah, for sure. Well, and I think the other, aspect, for me, as I was kind of considering this too, and kind of identifying the different kind of classes, right, is also like what we're defining as a C class here, single family home. It's one that has the opportunity probably for a rehab, that gives it the opportunity for a value add.
Yep.
Right? An A class home, typically speaking, there's not a ton you could do to rehab it, to make its value increase a lot, rather than maybe like adding a pool or something.
Sure.
Right? Like, adding amenities to it. But a C-class home is kind of like, hey, you've got older style cabinets or something, or the cabinets maybe just have some missing pieces, that sort of thing. Like, it truly has a value add component that is intrinsic to the home itself. Yep. Not necessarily just extrinsic, kind of add some paint to it sort of thing. Does that make sense?
It does. And you hit the nail on the head, and it kind of proves my point that investors will have different definitions. Yeah. But you're absolutely right. Like that is definitely a C-class type of property. Yeah. It's like you walked in, the structure is good, the bones are good, the neighborhood's okay, but the house itself, you walk in, and it's like, you just walked into the 70s show. And, and you're waiting for... Ronnie Howard to come walk it in or something, but that's Happy Days, isn't it?
Yeah,
I'm getting all my shows mixed up.
They're all in the 70s. Right?
Yeah, there you go. but you just walked into the home with shag carpets and stuff. So you're absolutely right. And for me, that's where we focus on. That is our bread and butter. I do love B class where they're a little older, but you can go in and not have to put as much work in. But C class is where you make your money, and yet that's where everybody's told to stay out of.
Yes. Yeah. Right. And I think since seeing and learning about the investment thesis that we have here at Freaky Fast, I've come to be convinced that we probably shouldn't be that scared of doing a C-class single-family fix and flip. Because, number one, like, we have this opportunity to add value to a neighborhood.
Yep.
Right? When we're coming into these neighborhoods, it's truly not this sort of, like, we want to push out the people who are, can't afford to live there or anything like that. We want to truly bring a home back up to its value that it truly should be, and we want to add value to that neighborhood.
100%. We've all lived in those neighborhoods.
Yeah.
That have that sore thumb that sticks out, and all the neighbors hate it. They dread it. Tori and I, when we bought our first house that we lived in Nashville, we bought it from a friend, and it was a rental property, and it had been the sore thumb in that neighborhood for years and years. My friend had bought it, and it was like, hey, I'll sell it to you. So it turned out to be a really great opportunity for us, but it was really, really rough. And I remember our neighbors coming over to us when we started rehabbing it, and we painted it. It was like an old ugly brick. We painted it nice white and had the new shutters, and it looked
brought it up to modern.
Yes, absolutely. And the neighbors came up to us and said, wow, like, thank you so much. Like, we all hated this house. I mean, people on streets behind us that weren't even on our street, they would be walking their dog and they'd be like, oh my God, what happened? Like, it just changed overnight. Like, they're like, this was the worst house on the block. Neighbors dread those houses.
Yes.
And they love it when they get rehabbed and updated, because not only does it take that ugly sore, like, out of, eyesight.
Right.
But it adds that value to those neighborhoods.
Yeah, absolutely.
And our house became one of the more expensive houses on the neighborhood just by doing basic work. It wasn't like we, did anything super crazy.
Yeah.
But we added value. And you hit the nail on the head, like, by doing this type of work, we are really, truly making a difference for multiple people.
Yes.
I remember someone saying, you guys are the problem. with the housing crisis right now. It's like, no, we're not that problem.
Yeah.
We're actually the solution to the problem. The houses we're buying are houses that people can't get loans on because they wouldn't qualify. They're distressed houses.
Right.
And so we're rehabbing those. We're bringing those, to the marketplace, whether as a flip for a first-time home buyer to buy, whether it's a rental property for a family who can't afford to buy at the moment because of where interest rates are, but they're looking for a nice, good quality home. They can come into there and make that their house, make that their home. And so we're adding value to them. We're adding value to the neighborhood.
Yep.
We're adding value to the community and the city, because now property taxes can, go up because that house is now, more valuable because of the rehab. Yep. And so we're literally helping everybody. And maybe most importantly, in my opinion, is we're helping our clients.
Yeah, absolutely.
By getting good investment returns on their investment capital.
Yeah, no, absolutely. And I think that moves to another reason why C-class single families make so much sense for us right now, is because from an investment point of view, I would say they are some of the best cash flowing vehicles that you can find on the market, right?
Yep.
Whenever you're comparing it with an A-class, property that's going to have less cash flow simply because the expenses are going to be higher to maintain that home over the cost of that time, a C-class one is going to offer a better opportunity for cash flow within that investment process. Would you agree with that?
Absolutely. And I think that was the old adage that you heard on a lot of podcasts. Yeah. You turn on a Bigger Pockets podcast, and this would be a very important topic, show topic. Cash flow versus equity.
Yes.
Cash flow versus equity multiples and growth on your dollar. And so a lot of times I'd be like, if you're really focused on the equity growth and the equity capital multiples, buy A-class property. You're not going to get a good ROI on your cash flow, but the equity growth and the appreciation is going to happen more there.
Sure. Yeah.
Well, in some cases, yes. Mm-hmm. But what we're actually seeing in a lot of these C-class and B-class neighborhoods is we're seeing appreciation growing in a lot of cases as quickly as A-class. Because, again, we're at a housing deficit. Right. So when interest rates come down, there's such a demand for those homes that it's forcing those prices to go up. And you're not going to see those prices really change. Yeah. So I truly believe we're on a pace to the 200,000 mark being the bottom dollar for a purchase price for affordable housing. Yeah. So it's like we're on that race. So if you can get a house for $60,000, put 50 into it, so you're all in 110. Now that property's worth 140, 150, you're going to see that grow to 200 over the next 2 to 5 years, which is going to give you maybe even a better ROI than what you bought in the A class. Right. So 5-6 years ago, A class was going to probably grow faster in appreciation and give you a better equity multiple, but that's not the case anymore.
Right. Yeah.
So the C class, you're getting better cash flow, and you're probably getting the same, if not better, appreciation as well.
Right. Yeah. And it's like you said, it's due to that whole supply chain issue that we're seeing in the world right now. So many people are willing to go to a Class C property that has been rehabbed and looks super nice because it's more affordable and they're just accessible to be able to get into.
Yep.
And so we're seeing that demand happening there as well. So I don't know. And then I think another thing that I see in terms of just like why single family C-class homes are attractive is we're not seeing that much competition in terms of an investment space, right? How many people are you reading right now in the single family space who want to invest in the same kind of stuff that you are?
Right. I mean, I think it's growing, but it's still very limited. And in a lot of cases, our competitors for single family rental investments is the bigger companies like the BlackRock.
Yeah.
Right? And BlackRock is definitely not buying in C-class neighborhoods. Like they've got their buy box. It's got to be 3 bedrooms, 2 baths, minimum. They prefer 4-2 now. Yeah. And it's got to be a minimum of 1,300 square feet. They prefer, 1,500 and up.
Yep.
It's got to be in good quality neighborhoods with good quality school systems. And it cannot be older than 1980.
Yeah.
Now they're kind of moving that mark to like 1975, but they don't want anything older than 1975. So what's happening is, and they consider those less risk investments.
Right. Yep.
The problem though is and they're okay buying with the idea of, hey, we're going to make a 4 or 5% return on our investment.
Yeah. Yeah.
Well, the reason they're okay with that is because they're managing money for billionaires, and 4% on $1 billion is a decent amount of money.
Yeah.
And the
right.
billionaire is like, hey, I don't want you to lose my money.
Yeah.
I just want you to put it in a safe investment that's going to consistently cash flow and grow over a period of time.
Yeah.
We're not that.
Yeah.
Right? Like, I don't have to be a shark. I could be a sucker fish. Like, I'll go to the markets that they're in, but I'll buy the houses that they don't want to buy. I'll buy the 2-bedroom, 1-bath, 1950s house that's 900 square feet.
Yep.
I'm okay buying that because I could buy it a lot cheaper.
Yep.
I'm going to be able to rehab it cheaper because it's a smaller house.
Yep.
It's going to cash flow, and it's going to cash flow much greater than what their investment is going to be. So I'm going to be able to go around to my investor and say, hey, look, you invest with me, and I can buy this house for $60,000.
Yep.
Rehab it, put another 60 in, it's worth 120. It's going to rent for $1,200 to $1,500 a month.
Yeah.
And it's probably going to be worth $150,000. So you just made a $30,000 equity play right out of the gate, and it's going to cash flow almost 10%.
Yeah. Yeah. No, and that's, it's insane, guys. Like, I'll tell you, I've looked at the deals that we have in our pipeline right now. I've looked at the way that we run the numbers on these sort of things. Like, our acquisitions team will not bite on a deal unless there's a 20% equity cushion. We all love a 20% IRR, right? Yep. And that's like the bare minimum for the type of threshold we're looking at whenever we're looking at these deals. And again, those deals are out there, they exist. You just have to have the appetite and you have to have the expertise like we do in-house to be able to go into those homes, to be able to actually realize that full potential within that home.
Yep.
Right?
Absolutely.
So I don't know. That's what I would say. It's incredible the type of deals that we're seeing out there. They do truly exist with that 20 to 30% equity gap and that 10% cash on cash return, like you're saying, in rental income. It's an amazing field to get into.
Oh, absolutely. And, what's also crazy is that, to kind of go along with what you're saying, a lot of people are told that C-class is riskier. Well, it is riskier than the A-class.
Yeah, for sure.
Because there's more work that needs to be done.
Yes.
However, it might be a riskier investment for somebody who doesn't do this as often as us. They watch HGTV, so they want to go in and they want to flip their house.
Yeah, they got their sledgehammer ready.
Yeah, they're ready to go.
Knock down the walls.
It's riskier for those guys.
Yes.
But if you could do it with a company like us, that takes away a lot of that risk. We've done hundreds of these homes.
Yes.
We've exited a lot of these homes, meaning we sold them off. It lowers a lot of that risk, and it provides, again, a little bit bigger upside for our investors. So the question I always ask them is, if Warren Buffett came to you and said, hey, invest in this deal, and within 90 to 120 days, it's going to grow 20%, would you do that deal? Well, the answer is yes.
Of course they would, yeah.
Right? Who wouldn't?
Yeah.
Well, that's this type of deal.
Yeah.
Because we're buying these properties anywhere between 40, 60 cents on the dollar, going in, rehabbing that, and once that rehab's complete, providing a 20% equity just right out of the gate. Before cash flow, before depreciation, and before any annual equity growth or appreciation.
Yeah.
Most homes appreciate anywhere between 5 to 10% on average.
Yeah.
So, again, it's just an opportunity to continue building that growth. Then you know what you do? You refinance it.
Yep.
You use that equity that you just created to refinance, pull out a majority, if not all, your principal.
Yep.
And then reinvest that principal into another deal with similar numbers. And you keep doing that, and then before long, within a 2 to 3 year period, you could 2 to 3x your investment. And that's what we're doing here within our equity funds for our investors.
Yeah, absolutely. It's basically taking all of the things that you could learn doing real estate investing yourself online, and it's basically putting that on fast forward.
Yep.
Like you remember in the old days when you could take your VHS and actually like fast forward it and like watch it in like super speed, right? Like that's what we're doing with your real estate investing portfolio on a large scale here. It's incredible what we're able to do. And I think, the other aspect for me kind of coming in from the outside too was like, I looked at some of these like markets we're investing in, and that's again something we'll talk about on another podcast at some point as the exact markets we're investing in. and I was like, man, I've never like heard of some of these markets we're investing in. You know what I mean?
Yep.
And I think part of it is like what we were talking about earlier of like there's just not a ton of competition in these spaces,
Yep.
right? For people who are wanting to purchase these types of homes. And I think that really gives us our edge whenever it comes to this particular market that we're investing into.
Absolutely, because again, everyone wants that safe bet.
Yeah.
Hey, have you noticed, like, movies today, very few of them are new concepts or new ideas.
Oh, it's so annoying.
They are superhero movie after superhero movie after superhero movie, or, you know, it's some, like, remake of something else.
Gosh. You know, my least favorite thing they do right now for remakes, we're getting off topic here, it's okay, but is whenever they take the old classic Disney movies and they decide to make a live action version of it, like that's somehow a good idea.
And then they animate it. And then, you know, so like you got 5 versions of this one.
Yeah.
But the reason I bring that topic up, I know it seems like a rabbit trail, but I do have a reason for that. It's people don't want to risk. They know that those movies will sell tickets. It will put butts in the theater seats.
Yes.
So they're willing to put away their creativity.
Yes.
To do a proven concept.
Right.
Because it lowers risk.
Yes.
Well, so many people, investors, they want to lower their risk that they're not willing to do something maybe a little bit more creatively.
Yes.
And so therefore, they're not getting the type of returns. So you see people say, oh, well, I want to invest in real estate. So they go to the main markets, the Dallases, the Nashvilles, the Boise, Idahos.
Yeah.
And then you'll start seeing them kind of branch out into the smaller ones. So instead of doing like primary markets, if you do a secondary market or even a tertiary market, and I can never say that word properly.
Tertiary.
Yeah. You know, my wife makes fun of me sometimes. I was not good in phonics, I promise you. But how do you say that again?
Tertiary.
Tertiary. You know, I can't say it.
Tertiary.
Anyways, and look it up. You know, Siri, how do you say? No, but when you can invest in those particular markets,
yes,
you are maybe taking a little bit bigger risk, but like you said, there's not as much competition. You're getting better ROI, and there's ways to maybe lower that risk. I remember going into Columbus, Georgia.
Yeah,
this was 2019. Nashville was booming. Nashville was one of the hottest markets, and everyone in Nashville said, "You're crazy going into Columbus, Georgia." The reason I did it, first of all, is there was so much competition in Nashville. It was hard to get a good deal.
Yep.
People were overpaying.
Mm-hmm.
I went into Columbus. It was a small town, 200,000 people. Mm-hmm. But they had what I call circuit breakers. Mm. So they had multiple industries that provided economic resource to that town.
Yes.
That if one of them went bad, well, the town's not going, kapooey, right? Like it's not like turned into a gold miners type town, and then the gold rush goes away, and now it's a ghost town. Yeah. And so, like Columbus had multiple Fortune 500 companies. They had Aflac's headquarters, TSYS, largest credit card processing company. Then they had working class factories like Kia Motors had a motor plant there.
Oh wow! Yeah.
They had a medical district. They have the military base. Yep. They had a college. So you had all these different economic, what I call circuit breakers, to help stabilize that economy. So even though it was a smaller market, a lot of people weren't going there. To me, it was still a safer bet. And so as we start looking at different markets, we're looking at different economic stimulators to determine whether or not if it makes sense for us. Yep. And then also determine, hey, there's a lot of opportunity here. There's a gold rush here.
Yeah, no, absolutely. And I think that's why I like to kind of go back to one of the things you said earlier of like, I think people want to invest in like a Dallas or an Austin, or in Texas, so those are the markets a lot of people go towards, is people are moving there, right? There's tons of people moving there, and so there's this idea, well, like population growth automatically equals, more, housing that's going to be needed there, and so on and so forth. But honestly, what happens whenever you invest in those highly volatile markets is you have a lot of tenant turnover. Because there's a lot of new supply coming into those markets, honestly, what ends up happening is you have somebody who's in a really good A-class property who's like, oh, well, there's a more affordable A-class property down the road now that's a completely new build. Like, I'm just going to go move into that one because
Yep.
it's cheaper and it's newer and it's 5 minutes from my house.
Yep.
Right?
Well, you make a great point, and to add to that, most people living in A-class properties that are rentals are looking to buy a property.
Yeah.
So it's just kind of like a stopgap until they can find the house they want to buy.
Yeah.
So you're right. You see a lot of turnover for multiple reasons, whereas a C-class, it might not be that case at all.
Right. Yeah. Because those people are typically tethered to the communities that they're invested in, that we're investing in at that point, right? Like, they have a good job that has tied them to that community. And so they want to stay in that community for a long time, and they need something affordable because, again, that's the type of thing that they're moving towards at that point. And so it's keeping them in that home. It's keeping them there for longer. So we have less volatile turnover, I would say,
Yep.
in our properties.
You're absolutely right. Hopefully that answers that question. Why C-class?
Yeah, no, absolutely. I mean, I think, hopefully after listening to some of this conversation, you've kind of understood a little bit more of, like, why do we want to invest in C-class, why we see there's opportunity there, the huge equity gap that we're able to realize within these homes, the great ROI we're seeing in terms of cash flow from these rentals. It's a huge gold mine that we're unpacking here.
Yep. I mean, there's a lot of scalability, and there's markets all across the country that still have these type of deals, and we can beat the competition there.
Yep.
And then what's also really encouraging is when someone confirms that you made the right move. For example, we just started doing Toledo, Ohio, which I'm super excited about.
Yeah.
And shortly after, the Wall Street Journal came out and said, why Toledo, Ohio could be the next gold mine. And I'm like, yes, And so
Yes.
we're identifying these markets, trying to be good stewards for our investors, trying to be good
Yep.
stewards for the future of our company and the growth. And there's markets all across the country that provide great opportunities for, like what you said, cash flow and economic multipliers and growth, but also scalability.
Yes.
And we just keep repeating what is working and adding to it and building on it. And at the end of the day, it doesn't have to be prestigious.
Yeah, that's right.
We're not looking for that. We're looking for performance.
Yeah.
And if we can perform, that's one of our core values here at Freaky Fast is production. Like, nobody's looking for that free agent who barely bats .250. Has plenty of errors. They want that free agent that is, batting above, .250. They're consistent. They're producing.
Yes.
They add value to the team. They add value to the clubhouse. They create wins. That's what they want. And at Freaky Fast, we want to be producers.
Yes.
We want to be able to take investment capital and turn around and produce great returns for our investors. And we believe that C-class and B-class properties are the best ways to do that.
Yeah, absolutely. When you're ready to learn more, feel free, here in the show notes, we'll link my calendar link. Feel free to sign up for some time. We'll walk through our current investment opportunities that we have available here, and we'll help you increase your passive income, grow your wealth by investing here with Freaky Fast. Thank you guys so much for joining us.
Absolutely.
It's been an incredible episode.
You've been listening to Building Generational Wealth Brick by Rick, doing single-family rentals, and we appreciate you being a part, and we'll see you next time.